Good morning, afternoon, and evening, everyone. A warm welcome to Acuity Knowledge Partners webinar, Navigating the Leveraged Finance Tightrope, Power Steering Credit Governance to be Future Ready. I'm John Lucchese, Senior Director, Sales and Business Development at Acuity Knowledge Partners in New York, and your moderator for today's discussion. From a housekeeping perspective, we request all attendees please stay on mute during the session. Our interactive session will run for an hour with 50 minutes for roundtable discussions and the remaining time for Q&A. To ask a question, please submit it through the Q&A box at any time during the discussion. We'll address questions during the Q&A session. We have a great attendee turnout today, including senior leaders from leveraged and structured finance businesses, chief risk officers, credit officers, and experts from underwriting and portfolio management from global and regional financial institutions. Thank you once again for joining. I'll give a quick introduction to Acuity. We're the leading provider of research and analytics support with over 500 global financial services clients, including the leading investment, corporate, commercial, and retail banks, asset managers, PE, and VC firms. For banks, we're a one-stop shop supporting clients across leveraged lending and portfolio monitoring, investment banking, sales and marketing, financial crimes compliance, credit risk management, and analytics. Our bespoke solutions help our clients achieve better return on investment, driving efficiencies, improving risk management, and reducing their costs. And here you can see our lending services highlighted, along with our leveraged finance services. I'm delighted to ask our esteemed panelists to briefly introduce themselves. Dave, perhaps we can start with you.
Yes, just getting myself off mute. Hi, everybody. Dave Martens. I'm head of portfolio management for Natixis. And just to put a little bit of more information on that, it's we're on the private side. We manage about, call it 400 different positions, and we will buy and sell. But for the most part, a good part of our work is in maintaining that portfolio. My background prior to Natixis, few different institutions: Morgan Stanley, HSBC, ABN AMRO / RBS, and then it goes back further and further. I started my career at Manny Hanny, which is always a gating comment for me, because if you know what Manny Hanny is, it's Manufacturers Hanover Trust. It's before JP Morgan. Then I know you're of a certain age. I think that's it. I don't know if we're doing fun facts, but I guess my
Sure.
Fun fact is that I still enjoy doing motorcycle track days, which is sometimes more exciting than leverage loans. But I'll turn it back to you, John.
Thank you very much, Dave. Appreciate it. Jeff, good morning. Could you please introduce yourself?
Sure. Good morning, John. Thanks. I'm Jeff Kalinowski. I lead KeyBank's Leverage Finance Portfolio Management Group. We're responsible for underwriting leverage loans across the bank, and then as well as management of a multi-billion-dollar portfolio. I have spent my entire career at KeyBank, 27 years. Previously worked in some different groups across the bank, including healthcare, real estate, technology, corporate syndications, but I've been in the leverage finance world for about a dozen years. I'm a graduate of Miami University, and maybe my not so fun fact is I'm also a graduate of Case Western Reserve School of Law, so somehow managed to get through that and then decided, boy, I really hate this. Came back to banking.
Excellent, Jeff. Thank you very much. Good morning, Manfred. Would like to hear from you, please.
Hey everyone. Manfred Affenzeller. I have been at Deutsche Bank for 18 years, and all those 18 years in leverage finance. I'm the co-head of the US leverage finance business, and as part of my job, I also oversee what we call the analytics team, which is basically the portfolio monitoring and management team within the bank. Similar to Dave's world, we oversee over 400 positions in that book, and it's multi-billion dollars large, as you can imagine. As you can probably hear from my accent, I'm not from here originally. I was born and raised in Austria. I came to the US about 20 years ago for business school, Columbia, then graduated, joined Deutsche Bank straight out of Columbia, and have been here ever since. My fun fact is I bike a lot. So unlike Dave, it's actually bicycles, not motorbikes. I did close to 7,000 miles last year. Why that is relevant, that is also approximately the distance between where I'm based, which is New York, and where the Acuity team in India is based. And then I also have a non so much fun fact, which is I had to get up at 3:30 this morning because John initially asked me to do this and sold it to me as a breakfast in Midtown. Now we did a webinar. I had to change travel plans. I'm traveling today. I had to get up at 3:30 to catch a 7 o'clock flight to be on the ground on time for this. So if I get tired towards the end of this, please understand. So thank you, John. Back to you.
Thank you,
Well,
Manfred.
Manfred, you and I travel about the same amount of mileage on our bikes. I just want to say, we're about even on that respect. So we travel about the same amount. So.
Excellent. Well, I aspire to travel half as much as Manfred on my bike, but half as much would still be quite a feat. Thank you, panelists, very much for the introduction. I'd like to mention a quick disclaimer before we start. The comments from our panel today represent their own personal views and not necessarily the views of their organizations. With that, the focus of the conversation today is the outlook for leveraged finance market in 2023 and beyond. At present, it remains uncertain. After a circa 70% fall in issuance levels in 22 on the back of tightening credit markets, global recessionary pressures, and an uncertain inflation picture. Lenders are closely monitoring leveraged portfolios as they expect speculative grade default rates to surpass the long-term average of 4.1%. How will the leveraged finance market perform in 2023, and what role will robust credit governance play in improving bank margins and navigating uncertainty? With that, let me start by asking, I'll go to Jeff for my first question. Jeff, how do you see multiple headwinds, including the rising interest rate environment, GDP contraction, liquidity tightening, affect the credit market in general? And where do you see the leveraged finance sector in 23 and beyond?
Thanks, John. I want to address those issues you listed separately. Interest rates, I would say, are probably having the most immediate impact. That is already hitting our higher leverage borrowers. You think the kind of vintage 2021 deals, those borrowers that didn't hedge heavily and hedge early are really looking right now at an interest rate that's roughly double what their rate was at closing. So if you think of say a 7 times traditional first lien, second lien, 7 times deal, that deal at best right now has an interest coverage of 1.5 times, possibly less, which really does not leave much room for anything else. Doesn't leave a lot of room for capital expenditures, taxes, or what we like, debt repayment. All of that is of course, potentially being complicated by a SOFR conversion that's coming and could add to interest rates. As we look at a lot of loans that have fallback language that will put a credit spread adjustment in that at the moment is higher than the gap between LIBOR and SOFR. So we could see those rates pushed a little higher by that conversion process. The second thing you mentioned was GDP contraction. To me, that's really the biggest question mark right now. We're seeing a lot of signs that we won't see a recession, right? We see a strong Q4. I think the revised number this morning was 2.7% growth. Unemployment is at a 50-year low. The consumer appears to be resilient. January had roughly 3% retail sales increase. All of those things certainly don't suggest a recession, excuse me. Moody's Analytics recently used the term slow session. They're not expecting a decline, but they're expecting certainly a slowdown. I would say our CEO, among many other bank CEOs, is expecting a recession, but expecting it to be mild, likely late 2023 or early 24. And that's, I think, something we have to kind of prepare for. I would say we're not yet seeing a wide impact on performance, but some surprises on CPI and PPI really are kind of raising expectations for Fed tightening, which could potentially push us over the edge. Liquidity, you mentioned, I will say that is has a potential to impact deals that need refinancing. The good news there is there's not really an imminent maturity wall. In Q4, we had kind of an open window and a lot of borrowers were able to refinance or extend. So there's really only, and I use the word only kind of loosely, $79 billion that's coming due through the end of 24, but that's only about 6% of the term loan B market. So we shouldn't see the pressures from a maturity wall. Those that do need refinancing now have to look to other markets. Can they fit into a pro rata bank market? They may need to raise sponsor equity, or they may need to go out and put something like a PIK preferred piece in place to reduce the leverage to fit that bank market. Looking further into 2023 and beyond, I think you may see banks tightening. Banks put a lot of assets on in the back half of 2022 as the term loan B market and the high yield markets kind of backed up. A lot of those deals came onto balance sheets, both in the term of hung syndications and in just revised pro rata deals. So banks are starting to go to the capital markets to raise capital, raising rates on deposits to bring deposits in. And you might kind of get the impact of credit tightening as well if the economy weakens. So we may see banks tightening through 2023. Beyond that, eventually the CLO market will return. We just don't know when that really is. CLO issuance is kind of growing in the beginning of the year, but there's still a lot of deals sitting on banks' balance sheets, and it's going to take quite a bit for the CLO market to absorb those. We may see some things like sponsors looking for gaps in documents to do things like prime lenders, which could get interesting. One thing I will say is I don't expect leverage to go back to, say, the 2021 peak levels because the interest rates just won't allow it.
That's terrific, Jeff. Thank you very much. But, Jeff, you mentioned balance sheet growth and also some tightening. Maybe I'll go to Manfred on this next one. Manfred, could you elaborate on the health of banks' balance sheets as it relates to leverage lending and the ability to potentially absorb loan losses?
Yeah, thank you, John. And I think there are two big components that are relevant for this question. So one is the underwriting losses. So banks in the underwriting business today have basically an underwriting book where there's short-term park commitments, and then the relationship book that I think a lot of folks on this call today manage or are involved in. Both of those got hit during 2022 and the rates volatility that Jeff spoke about. So let's start with the underwriting book and the losses there. So maybe a little bit of a quick leverage finance 101 primer for anyone who does not live and breathe this every day. So banks take basically write commitments to clients, book them in those underwriting books, and basically commit terms, certain terms to the clients. Think of it like when you lock in, you only closes, sometimes several months later. Same here, banks write checks with terms attached to them. And then when we see an environment in 2022, when rates start running up and basically those commitments then start being underwater, and banks have to crystallize losses on them by either selling them at a loss to the market. Again, those books are not held. Those books are not created to be holding those positions. It's really a syndicate book. So if the banks can't yeah, if the banks can't find buyers, and make money out of it, they usually try to sell them at a loss and crystallize losses that way. And then the positions that cannot be sold, like Twitter, for instance, which is still out there and hasn't been syndicated, is the banks have to use their judgment to do mark-to-market losses there. I think that those type of losses were the bulk of losses on banks' balance sheets last year. Our estimate is that those losses were somewhere north of $10 billion across the banks. That sounds like a big number. Having said that, to put that number in perspective, the Lehman crisis, which some of you may remember, estimates there from the IMF and other sources suggest that the bank losses were north of $1 trillion. So we are talking, losses today in the underwriting books of 1% or so from the Lehman days. So while the 10 billion is bad, it's certainly not something that banks cannot absorb. And then I think but then actually when you look at the filings of banks, not many have actually explicitly called out losses in the leveraged lending or leveraged underwriting businesses, because I think the Lehman crisis also, the lessons learned there for banks were risk, mitigating risk through hedging programs and other factors. So I think a lot of banks have hedging programs in place today that absorbed a lot of those mark-to-market losses or actually crystallized losses. So really, at the end of the day, while 10 billion would be the notional amount of losses that we would have expected, looking through all the underwritings that the banks had in the books, I think hedges helped to offset a lot of that, which again is the reason why we didn't see much of those losses reported in any or in any of the bank's quarterly calls. At Deutsche Bank, we were also pretty lucky. I think we came out of this, relatively well, from what I can tell, compared to our peers. Our losses are less on the percentage-wise from this $10 billion pool versus what our market share was in 2021. So we are under-indexing from a loss share perspective compared to our market share during a normal year, which is good, and we are back in the underwriting business. The other component of all of this is the relationship book. Again, the whole book, or client book, whatever you guys may call it. I think there, we have seen banks increasing the amount of loan loss provisions in their statements. But I think that is a pretty well-established process, right? Together with the internal credit team, auditors, the finance department, it's a pretty well-established process. And clearly, when you see an environment like in 2022, you would expect loan loss provisions to be adjusted up. And I think there's again, those numbers did not surprise anyone. Nothing jumped off of any of the reports to people by analysts. The banks are trading well. So I think banks' balance sheet overall, to answer your question in a nutshell, are pretty healthy despite all the volatility.
Great. Thank you, Manfred. Maybe touching more on the evolving credit conditions, Dave, I'd like to pose this to you. What do you see would be the impact of worsening credit conditions in the North America region across sectors, including stagflation-sensitive sectors? Are there any key sectors or industries that you feel may drive growth in the lending space in 23?
Yeah, so I'll echo some of what Manfred and Jeff had mentioned, that the current, and I mean today, the current market conditions are just very interesting, right? Because we've had this, I think, rather large swings in sort of macro forecasting over the last 12 months that it's fairly rare that we've seen this in the past. I look at, what we were worried about all last year leading up October, November, we were worried about this inflation and interest rate increasing spiral. And, if you were panicking, you were seeing no end in sight. And then right around the whole Davos meetings, all of a sudden people started talking about, well, I think we're okay. We're sort of past that point. And so there was a pivot away from that sort of disaster scenario, if you will, about ever increasing interest rates and inflation. to now more real. And I think the Texas house call is that we won't even see a recession right now. I personally believe in the business cycle. Before the pandemic, I felt that we were sort of headed for a recession, and then you had this obvious disruption in the pandemic with both, the loss of productivity, but also massive liquidity. And so I think people are still trying to figure that out. What does that mean? I personally believe that we are still headed for a recession, just maybe later than what we might have thought, or what I thought 2 or 3 months ago. I think the distressed debt, I looked at Moody's, their B3 count the other day in terms of, actual positions, and it's up to about 220, which is a long-term average. So, okay, that's not bad, but it's from a low of 175. So obviously the trend, even though it's an average right now, the trend is not good. I think one of the other things we worry about is that, my understanding, even in some of the surveys I've seen, is that the last 3 or 4, 5 years of expansion has led to cheap bank financing. And so I think right now, 75% of the leveraged loan market just has bank loans. Whereas, if I go back to like 2012, 2013, there was only 50% had just bank loans. They had other levels of debt. And I look at that from a restructuring perspective. If you do have difficulty, it's nice to have debt that is used to earning more, used to taking more risk, already involved in your company, so that when you obviously have a cushion to the senior lenders, but you also have people who are interested in taking more risk involved in your loans, and so that can help in restructuring. And the less of that goes on, the more difficulty you may have in terms of some of the other restructures that may come up. So specifically, I think the 2 industries we're maybe more concerned with these types of conditions is, one is the healthcare. We've seen a lot of PE firms investing in healthcare and then making them more efficient, but healthcare tends to not have that explosive growth. And so when you raise the interest rates on that, so we're concerned in general about healthcare. Obviously, there are some good healthcare situations and some bad ones, obviously, but just in terms of sort of a general industry. The other thing we're maybe more concerned about is the service industry. Again, not usually something that's been a problem in the past, but I think with some of the labor market stresses and things like that, those are causing costs to go up. And again, you're not seeing any growth to grow out of the fact that the interest rates are going up. So those are the concerns, I think, in terms of growth, or the good things. Like my fellow panelists, we are surprisingly not seeing a lot of specific problems just yet. I think some of that is due to the hedging. I'd like to throw in an advertisement for our underwriting skills, but that's not the point. I think across the banking, we're not seeing this sort of explosion of issues that are popping up. And again, maybe that's because of the hedging programs that we've had in place. Obviously, with all the covenant lights, it's hard to know exactly. The market for leverage loans, again, we don't trade too much in this, but it clearly has bounced back. From I think July was sort of the low point there. So there's clearly more money and more liquidity around this market, which I think is positive for all of us. Private credit market has gotten bigger and bigger and bigger. And again, I think the pension funds are now putting 5 or 6% allocation into private credit, and again, more money into the area is usually helpful, not for competition reasons, but in terms of risk reward reasons. And I think just a couple of quickies where I see the expansion areas. The renewable space, because the IRA Act, the Inflation Reduction Act, is clearly exploded. I think anyone sort of in that space has seen just tremendous explosion, and not just in new projects, but in, we'll call it warehousing for lack of a better term, but where private equity money comes in and actually buys some of those facilities that are already up and running, and leverages those on top of that. So there's all sorts of growth in that space, and that I see continuing, for a long time. So I think that's one area of people are going to be putting money into that. And the aerospace, chemicals, metals, and mining are the other things that we see growing, all related to renewable space and EVs and things like that. And the aerospace industry just feels like it has a lot to make up for. So that's it.
No, terrific, Dave. Well, you touched on it. Manfred also mentioned banks hedging programs, perhaps helping to mitigate some of the loss scenarios. I'd like to ask Jeff, getting back to kind of default rates, how do you think the default rates will behave across the rating classes? Do you think there'll be an increase in fallen angels? If you could share your view on that.
On default rates, I would say we certainly expect an increase, and the market is certainly expecting an increase in rates or in default rates. For example, the recent JP Morgan forecast is for 3% of high yield and 3.5% of leveraged loans to default. That's roughly double the current rate of defaults. I would say Moody's has somewhat higher expectations. The interesting thing about that is, even though it's double the current rates, it's really about equivalent to the historical average. We've seen recessions kind of customarily show 6 to 10% default rates. So the current forecasts, at least, are not to get to that level. I think as David mentioned, current distress levels are up and are roughly double what they were before, which sort of supports that expectation of increasing default rates coming down the road. So the market is certainly, kind of looking for that. The interesting thing about this market, and David mentioned a little bit of this, is that the high yield market may actually be better off than the leveraged loan market this time around. And it's a lot of those highly leveraged deals don't have high yield. They kind of are all leveraged loans. If you look back to the 07 market, loans were mainly a double B asset class. High yield was really roughly in the B2 range. That's flipped a bit. And right now, 40 to 50% of high yield issues are BA3 or better, where leveraged loans really average roughly B2. So, what we may see is we may see leveraged loans do much worse off this time as compared to high yield than we've seen in previous downturns. The issue borrowers are having, obviously, is that you have a combo of a slowing economy and maybe a recession and rising rates. And those two things are kind of crimping cash flow from both sides. For the high yield market, the good news is debt to EBITDA is really kind of at historic lows for high yield. Liquidity is pretty strong. In the leveraged loan market, it's really the opposite. The level of B3 or worse paper is really high. You have CLOs right now holding a relatively high level of CCC paper, and they have limited buckets for that. So we could see, if we see a wave of downgrades, we could see some increased CLO selling, which kind of could lend to that further distressed debt level. As far as fallen angels, it's really going to depend on the economy. If we see a deep recession, we certainly could bring a wave of downgrades. The good news, at least in the high yield market, is you have about $160 billion of high yield paper that is close to and maybe expected to be upgraded to investment grade, which potentially will lead to a shrinking of the high yield market in 2023 as more of that paper moves up than new paper comes into the market. Some of those rising stars, for example, kind of in the energy sector. For example, Occidental Petroleum, a large issuer, is right now kind of on the cusp and maybe expected to be upgraded to investment grade. So we may see the high yield market do a little better. The leveraged loan market may get punished a little more than previous years.
Great, Jeff. Do the other panelists any other comment on either fallen angels or rising stars before we move on?
Not from my end. I think Jeff did a great job.
Okay, great. All right. I'd like to remind the attendees also to please get any of your questions in to the Q&A box. We'll try to get to your questions as they come in. Manfred, I'd like to turn to you on the regulatory environment. It's of great interest to today's attendees. Has the regulatory environment adjusted to higher interest rates and the more challenging economic environment?
I think a bank regulator's job, by definition, is not to be the most dynamic and quickly adjusting job in the world. So the short answer is no, and that's also not the goal of the regulator. The goal of the regulator is to basically create a safe and sound banking system in the long run. So I think they're trying to stay away from reacting quickly and swiftly to anything they see in the marketplace. And there's nothing different in this environment right now. I think they are sticking, from my interaction with the regulator, probably many of you on this webinar today, they're sticking to the leverage lending guidelines from 2013 and the consecutive FAQs that they issued. After that, there have been no updates ever since, and I don't expect any updates anytime soon, as I said. What that means is, right, I think as Jeff alluded to, with the high interest rates, obviously our cash flow models start paying down less and less. So for new originations, clearly leverage needs to come down, and needs to come down probably fairly dramatically from the levels we have seen pre-2022. So Jeff alluded to it, but right, your fully levered LBO from late 2021 or so, with interest rates in that environment that got you to a fixed charge coverage ratio of roughly 1.5 or so, if you do have a back of the envelope math. Today, you run that same structure, same model at the current interest rate levels, and you get much closer to 1. So really no room at the old leverage levels. And as I said, all of that indicates that leverage will come down with new underwrites. And that is not a problem. I think everyone is on the same page there, right? The market wants to see leverage come down, so investors will not buy debt that only has 1 times fixed charge coverage ratio out of the gate. The agencies are laser focused on it, so the agencies are on board, and even private equity and companies realize that free cash flow is king, and you wanna get out of the gates with some solid cushion to free cash flow there. So I think today it's not an issue. I could see it become an issue if the market comes back, private equity gets more confident in the near term. They start underwriting, fairly aggressive models again, because they really believe in rates coming down, the economy firing from all cylinders, and come up with equity cases that would support more debt. And then we credit people, so all of us on the phone here obviously take more of a backward-looking and more conservative view, and we may be much more conservative than they are in our views. So that's when I think in the relative near term, the guidelines from the regulators could become an issue for new underwrites, and then that may steer even more business towards direct lenders. But then I think it's a temporary issue, right? If private equity then turns out to be right, and the economy is firing from all cylinders and interest rates are coming down, then then we will adjust our forecasts accordingly, and we'll be able to do more aggressive deals going forward. So long story short, don't expect the regulator to do anything in the near term. Don't expect this to be actually an issue in the near term. In the medium term, there could be an issue with differing views of private equity versus us credit people. And then in the long term, again, I think we will be fine, and the guidelines will remain the guidelines along the way, and we will structure our deals accordingly.
Great, Manfred. Dave at Natixis or Jeff at KeyBank, any other view that you might have on the regulatory environment?
Yeah,
or is it consistent?
I mean, fairly consistent with that. I think some the seminars I've been, or those now these in-person group meetings are coming back and talking with various counterparts doing the same thing at different banks. There seems to be, and this is a fairly normal request of some of our regulators and some of my colleagues regulators is, more of a written process and procedure to deal with higher interest rates and or inflation. And so, in any underwriting, no matter what the environment is, you're already taking those things into account. You're taking into, a competitive advantage of your borrower versus others, and how they would deal with shocks to the macro environment, all that kind of stuff. But that's all part of normal underwriting. What I've seen more recently is some requests coming through like, well, where is this in your policy that you are, looking at this specifically, or where is this in your procedures that you're looking at it? And, to some of us, it's embedded in exactly everything we do. We may not have a written procedure that says thou shalt do this with inflation. So we've seen a little bit of that, or I've heard a little bit of that more recently. But as interest rates, if interest rates are cooling off, then I don't know whether that's something that's a theme, or where that's coming from. So that's the only thing I'd add to that.
Yeah. Thanks a lot, Dave. Yeah. Okay, great. Dave, let me stay with you on this next question that we've gotten. Talking about ESG, a lot of interest in the overall ESG angle. How are you looking at ESG lending within leveraged lending?
So it's funny because ESG, it seems like the S and the G part of ESG is not getting a lot of emphasis these days. It seems it's all on the E, or the environmental stuff. I think that just as again a primer, the regulators are interested in both transition risk, in terms of the climate energy movements, as well as so transitional risk, as well as physical risk to the climate change. So, i.e., the sea levels rise a foot. What does that mean for your physical risk? So it seems to me the theme is coming out of the regulators. Those are the two ways they would like to frame the argument. We're just starting to see some guidance on that. And I've talked to a lot of colleagues who were saying, how are you guys dealing with this, and how are we going to deal with it? And I haven't come up with a great solution in terms of those two things. At Natixis, because it's French origin, it's the environmental things have always been very important. It's really part of the DNA of the bank. And I think starting back in 2014, 2015, they embarked on a fairly large project to include pricing of environmental risks into our deals in terms of internally how we look at them. And so we developed, again, this has taken 5-6 years to develop, but effectively, and I'm not doing it justice because it's more complicated than this, but we basically use a fairly large outside vendor to rate different industries and different companies based on their public information. And then that rating will affect our internal return for certain companies. And so we have a color coding system that goes from like a dark brown to a bright green. And if you have a bright green deal, then you get, in terms of our internal view of return on equity on that particular deal, you get a benefit. And if you have a dark brown, you get penalized. And so there's a way we sort of look at new deals with that framework in mind. We also have developed targets. We've taken that temperature scale and converted it actually into, the color scale, and actually converted into a temperature. And so we actually have targets that say the United States has to have a portfolio that is X amount. Again, I don't get into details, but it's basically another way to put targets on that. We're trying to do more environmentally friendly deals and companies. With the leveraged lending space specifically, there's a lot of diversity and a lot of general corporates in that book, and those are notoriously harder to rate. And so it's a lot of those ones do get a sort of a neutral rating, unless they're doing something really strange. But it is a framework that I think is helpful for the board to set certain targets. And obviously every board is going to feel differently about those. But I do think the Natixis has done a pretty good job of sort of developing that, and it still needs to be refined. But that's how we look at it.
It's terrific. Thank you, Dave. Well, I think we're right on time with our session so far. Panelists, thank you for this candid discussion and for your insights. It does answer a lot of questions about what the short-term future holds for the industry. And we're really privileged to hear directly from practitioners. We will again have additional questions and answers. I saw a couple additional ones come in. Please get your Q&As in the box in the bottom of the screen. Now, Manfred, before we start the next session, could you turn your screen on? I'm not sure if you just click your video on. There we go. Okay, thank you. I'd like to kind of address something. And Manfred, I've had the privilege of working with you and your team for the last 5 years. And a lot of the questions coming in relate to how leveraged lending teams can utilize Acuity services, how banks have gotten the most value from working with Acuity. And because you have a great experience with us, could I ask you to share a little bit of your experience and how you built Deutsche Bank's strategic offshore partnership with Acuity?
Yeah, happy to. And can you hear me okay?
Yeah, great.
Don't know why my screen turned off. Sorry about that.
Okay, no.
So maybe going back a little bit in time, in 2017 is actually when our corporation started, and that's when I was basically being asked to set up what we again call the analytics team, and we were in a in the luxurious position to basically start with a blank sheet of paper. So we had a small monitoring team in-house, but with the leveraged lending guidelines and higher standards towards monitoring and all that, we basically had to revamp what we had. And again, we had the luxury of being creative. Blank sheet of paper. What would a efficient, cost-efficient model look like that leads to high quality results? So we also had a small team in New York, as I said. We also had a small team in Jacksonville, which worked well. And then we had the ability to access Deutsche Bank's Mumbai office for labor in India. I always liked the idea of 3 legs to the stool. So New York, Jacksonville, and India. We started off working with the team there and realized those were shared resources within the Deutsche Bank complex. And I didn't get the attention I needed and wanted from them for the project. So that's, John, how you basically came into play. You did a good job with our local COO to make it on her radar. And she introduced you and me back then, and we started discussions. I obviously looked at other vendors too. We had another vendor with a strong Indian presence that we already had onboarded and did work with, not on the leverage finance side, but on the equity side. Did some work there. Turned out they were not the right vendor, so that's how Acuity basically got their chance. And again, we started off with restructuring the New York team. That has most of the senior people on the team, sitting next to me. Jacksonville has more of the junior population. We got pretty lucky that we have a pretty good recruiting system in the South, so we get very talented young people out of colleges into the Jacksonville office. And then with your help, John, and your team's help, we established the Acuity team in India. It was a fairly long and sometimes very painful process, I have to admit. The pain, however, was not because of Acuity. It was more, bank related, firewalls, IT, policies, procedures, all the things you can think of. And then after many months of work on that, we were able to basically fold the Acuity team into our IT environment, and they all have Deutsche Bank email addresses. They use the Deutsche Bank systems. They have some access to the Deutsche Bank drive that we're using for our monitoring activities. So once we had all of that completed, basically to us, the Acuity members look like DB members, right? There's no difference. And once we had that established, things went pretty smooth from there. I think that the biggest challenge, or not challenge, I think the biggest lesson learned from my end is connectivity, right? Obviously, as I said at the outset, the team is 7,000 miles away in a different time zone, but you know, connectivity is key. So what we do is we do once a week, we do Zoom calls with the New York, Jacksonville, and the Acuity team in India. We do it, you know, in the morning, obviously for time zone reasons, which is late in India. Catch up there every week on, you know, issues we have or upcoming earnings, and, you know, basically what's on the menu for the next week or so. Those calls can be as short as 10 minutes or as long as 45 minutes, again, depending on what's on the plate. But I think it's absolutely key to do those calls, and absolutely key to stay connected with the team that way. Obviously, then my team members have basically daily interaction with John's team and the Acuity team, based, you know, on the monitoring side. The way it's structured is, as I said, we have most of the senior teams are in New York. They oversee sectors. They then have juniors for the more you know, for the names that Deutsche Bank is agent on, for the names on the watch list. We use the junior folks in Jacksonville. And then for companies that are more or less performing okay, where we don't foresee any issues that are maybe less relevant in the overall lending footprint, we initially handed those to Acuity, and we used Acuity more as the you know, as the actual doers. They would, you know, update our monitoring documents, update the models, and then send it back to the senior who is in charge of his or her portfolio and in charge of the quality. So that there's daily interaction between Acuity and the seniors, and you know, Acuity came up the learning curve nicely, just like our juniors that we hire in Jacksonville, and now it's a very successful relationship. So yeah. Thank you for all of that. And I also, before COVID, used to travel to India to meet the team there in person once a year. Made sure that all those firewalls that were advertised were really in place, and can tell everyone they for sure are. Deutsche Bank, together with all the other banks, have separate rooms there, separate teams, right? The teams don't commingle, or some team member walks from one room to the other. It's all very much shielded off. Team members are not allowed to bring any electronics into those rooms to take pictures or whatever, and not be able to print anything and bring copies out. So it's very much isolated bank by bank. And yeah, I went there. I went there to make sure all of that was really the case. And I hope I can come back. I can go back again maybe this year at some point. So I haven't been since COVID.
Yeah, that's right, Manfred. And you're right. It was a very multi-step process to get the Deutsche Bank teams comfortable and to get that connectivity into the systems and to be sure the policies and procedures were followed. In terms of, improving the front office effectiveness and better credit risk governance, could you just talk a little bit more maybe about how you see the Acuity team kind of complementing your team? I guess it in some cases it's hard to tell, right, where the work is coming from.
Yep. No, for sure. And again,
Yeah.
I hope you can hear me okay.
Yeah.
Okay, good. Good.
Yes.
Yeah.
No, and I'll add that too, because obviously we're here because Acuity invited us, and I've been very impressed with the amount of things that since I got to Natixis, their Acuity was already working, and I'd worked with Acuity prior institution as well. But one of the things that when I got to Natixis, they were focused on, I believe it was aviation. And very quickly, I was like, no, I need them to focus on all of our, they need to learn all of ours. And within 6 months or so, we had most of our Acuity staff getting comfortable with at least doing annual reviews and things like that on all sorts of things. And so the learning curve was steep for them, but they were able to accomplish that. And that, after 6 months or so, I would agree that there's de minimis editing that we had to do on some of their work. And so I'm just impressed by that.
Well, I think what's common to both of your engagements and even Jeff's engagement, KeyBank's been a long partner with Acuity, has been the commitment that senior management makes to the engagements. Coming over to visit, spending time with the team, being sure we're integrated into your processes have paid big dividends. So, thanks to the three of you and your organizations for not only recognizing the value, but being committed to the path to be sure that our teams are treated very much as an integral part of your team. I think that's helped ensure the success. Thank you for that. That's terrific. What I'd like to do is get to some of the additional questions that have come in, and I'll throw this open to all the panelists. The first is about the Great Resignation. What's the impact of the Great Resignation on the borrower's financial health or within your own institution? How are borrowers coping, and how have you managed to deal with the Great Resignation?
I'll start out with that because I think I'd mentioned that in some of my remarks earlier. From a borrower perspective, we are more concerned about those service jobs or the in-person jobs. People seem to be, it's a harder time, restaurants, things like that, to get people to work. And when you do, it's much more expensive, right? So that business model for that physical labor stuff, or the things that you can't do remotely, seems to have increased costs fairly dramatically. And so we're concerned about that from, a borrower or lender perspective, let's put it that way. I think in-house, we definitely saw some major turnovers during the pandemic. I feel like that's settled down a bit. The latest, everyone knows the latest conversation is, oh, do you want to come back to 4 days a week? We're currently running 3 days a week in most of our areas. The general feeling is everyone's pretty happy with that. And adding that flexibility, I will add that, from a personal point of view, the people I've interviewed over the last 6 months, I've been amazed that this is their first question they ask me. I'm a pretty senior guy, and I really would have thought they'd come up with a question that was, a little bit more intricate or interesting to ask me than, what is our policy on flexibility in terms of working at home. But that's what I'm seeing. So there is obviously that concern, and I think institutions have to be flexible. We're not seeing the turnover, though, in the last 6 to 9 months that we did sort of in the previous year and a half. So.
Excellent.
Yeah, I think we're all seeing. No, go ahead, Jeff.
I was just going to agree with David. I mean, we're seeing on the borrower side, we're seeing impact in any kind of high labor market, right? Healthcare, transportation, truck drivers. One thing I would say is that some are reporting that's starting to ease a bit, particularly maybe on the transportation side, we're seeing some of those pressures ease a little bit. But it is having, different impact across different companies. We have one company that, small company that was recently acquired, and with the acquisition, they had a fairly high retirement rate. And it's a kind of a highly specialized manufacturing, and they've had quite a bit of difficulty filling those spots, which has affected their lead times. They've had to, they've kind of have to push lead times further and further out because they can't fill the spots that they need to fill. Internally, I would say we've been pretty lucky. We haven't seen the turnover, but as David said, in looking for new positions, interviewing people, always ask what our in office at home policy is. We're kind of hybrid, so we're 2 to 3 days in the office, but that is definitely a topic that comes up in every interview.
Yeah, I agree with everything. I think on the portfolio side, the further you work down from a cost of labor perspective towards minimum wage, the more the pressure on the borrower. Really at the lower skilled workforce level is where I think the biggest pressure is in terms of wage inflation and therefore margin compression. So I think we're all saying the same thing there. And it's, let's see, it's not going to go away, in a snap of your fingers. I think it's going to take a while for the Fed to get, inflation in control, including wage inflation. And then at DB, we are back at four days a week. I hope any potential recruits don't judge us here compared to the other peers on the phone, but we found 4 days is the right price. I think it's I think it's efficient, works well. Again, we're in an apprentice model where juniors are supposed to learn from the seniors in person, and it's just much harder to do on Zoom or on conference calls than actually in the office. So yeah, we transitioned from 3 days to 4 days a few months ago, and it has been working well. But as Dave said, also our turnover has gone down dramatically with the pullback in the market in 2022, right? The flexibility to just, move from one leverage finance platform or from one analytics platform to another has probably come down quite a bit. So we've seen less attrition for sure in the last 12 months or so.
All right. All right, great. Thank you, panelists. Here's a question that talks about, on the assumption that inflation eventually cools down based on the ongoing Fed interventions, do you believe the US markets would be back to 2020 levels of easy borrowing rates in the medium or long term? Anyone want to try their hand at that one?
Maybe in the...
I would say, personally, I don't expect that anytime soon. I think we've seen kind of historic low interest rates, and I don't see us getting to those levels anytime soon. I think we will see lower interest rates, but I don't think we'll see them that low.
And I think too, from my perspective, again, I was the guy who still remembers the lines for gas in the 70s. So you can figure out how old I am. That we're not even back to what I would call normal. And I say that personally, we're not even close to where we are, normal. This last 10 years has been, and especially the last 2 years, but the last 10 years even has been a fantasy land, right? Things have just sort of grown, and low interest rates, and no inflation, low interest rates. It's just been a little bit of a nirvana for the last 10 years, and I think we're gonna see a change back to sort of a mean, which I can't think of in my head what's the right environment that's the mean, but it's certainly not the last 10 years. And one of those things we were talking about, recruiting people, you hire somebody with 10 years experience, and other than the pandemic, they've never seen sort of a normal recession, right? They've never seen that sort of warning signs, and as you go through and what happens and all that kind of stuff. So it's an interesting time, I think, to talk about what's back to normal.
Right.
Excellent. Dave saw the Volcker rate hikes in the 80s. That's interesting.
I was on his committee, Manfred. I was on his committee, so
yeah, I would agree. I mean, I agree with everything said. I think if we ever get back to the zero rate environment, it's going to be in the very, very long run, and something has to go really wrong. I think in terms of really wrong in the economy, I think we would need to come to a place where just major recession, and the Fed needs to stimulate to bring rates down again to zero. But under normal circumstances, I think we are far, far, far away from getting to a 0% environment again.
Yeah,
it's also not where the Fed wants to be, right? They want to have some quivers left in case they need them. So I think it was a highly, as Dave said, a highly unusual time of the last decade or so, and kind of the perfect storm for the lending business.
Terrific. I have one last question. Maybe we'll do it in a rapid session, talking about the global economy not entering a recession in 2023. How much will the attractiveness of high yield bonds and leveraged loans go up? And what will be the competition among individual banks for new transactions? Anyone want to take a crack at that one?
I'll go quickly first. I think no, I beat you, Jeff. I think and I'll be very quick. I think the thing that I see is that people are a lot more worried about stagnant equity markets, or declining equity markets, and so people are constantly looking for that alternative. And I think that's where I see money sort of coming in. It's not banks lending more, it's more money coming into the space that traditionally hadn't been there. So.
Jeff?
Yeah, I mean, I would say, just to add a comment, we talked earlier about leverage points, and that I think, as Manfred said, that 7 times deal probably can't get done at maybe 5.5 times, right? The impact to banks that sell these loans, right, that syndicate these loans, is that that's roughly a 20% smaller loan. That's a 20% smaller fee pool out there. So I think you're going to see some really heavy competition for those loans because, bank executives got a little used to the 19, 20, 21 fees that were coming in. And that's going to be rough to do when deals have to be much, much smaller.
Great.
Yep, you have that. You have direct lending, intermediating a lot of the syndicated banks, shrinking the volume even more. And so, yeah, I agree with you, Jeff. It's going to be interesting to see how the syndication banks, I'm obviously in the syndication seat, will behave competitively. But I think it's going to be, after some initial, right, today, not many banks are back in the underwriting business. So today it's not, private equity is eager to find banks who write them big checks these days. So today it's not the issue. But as soon as there's stabilization in the market, and we see, conservatively structured deals getting underwritten, then I think the mindset is soon going to shift. It's like, okay, there's not enough deal flow, let's be aggressive. So I agree. I think we'll see some of that.
Excellent. Well, the panelists, this has been a terrific conversation. Really appreciate your bringing your viewpoints and your expertise. We haven't gotten to all the questions, so we will certainly get back to attendees that have submitted questions that we weren't able to get to. We'd like to basically just draw your attention to your contacts at Acuity, myself, Pedro, and Chaitan in the US. If you have any questions about Acuity's capabilities, and in Europe and the Middle East, Johan, Balaji, and Adrian would be happy to talk to you about our capabilities and help you illustrate some ways that we might be able to support you. Panelists, again, thank you very much for your participation, for your expertise, and I'd like to thank all the attendees for joining, for your questions, and hope you found it useful and beneficial. Thanks again, and have a great day, everyone. Thank you, Dave, Manfred, Jeff.